You're just too good to be true. Can't take my eyes off of you. You be like heaven to touch. I wanna hold you so much. And long last love has arrived.
Good afternoon, everyone. Blythe, it is a real pleasure to be here with you, and as you can tell from the size of this audience, a lot of excitement to have you here to talk a bit more about blockchain. And I have a guess that if we asked people to raise their hands of those who knew what blockchain was, knew its potential, we would get a good showing. But then if I asked a lot of you to come up here and explain it on stage, it may be a different story. So just kick things off, if you can just talk us through why you are such a strong believer in the potential of blockchain and how you can put some of those doubters, the non-believers, to rest.
Okay, I'll give that a try. And thanks for having me, by the way. It's great to see so many faces. I think probably the best place to start is to acknowledge that pretty much everyone has heard enough about Bitcoin, cryptocurrencies, and blockchains to have been confused in at least one dimension as to what this is all about. And therefore, when asked to explain this space, I often ask people to forget pretty much everything that they've read and heard about cryptocurrencies and Bitcoin, and instead dumb it down a lot and think about something no more complex or intimidating than good old-fashioned database technology. Because it turns out that actually when Bitcoin or cryptocurrencies were conceived of, they were seeking to solve a problem that enabled independent entities to exchange value over the internet without the benefit of centralized supervision or oversight from a central administrator. And to do that, you have to essentially design a way of tracking the value that is immutable and can't be messed with, can't be counterfeited, so it has to be supremely secure. And that security, or those security features that were designed to ensure that the log or the record of cryptocurrencies actually introduced some features, some technological features, that took the traditional or conventional state of database technology in a whole new direction, with the simple consequence that what was invented is a way where, for the first time, independent entities can safely or with responsibly mutualize or share database infrastructure, keeping just one record of important transaction information, which they collectively can refer back to with confidence, because it's secure, in the context of a multi-party identity management and authentication framework. And that allows you to do things in financial services that goes well beyond the narrow use case of Bitcoin or cryptocurrencies, and allows you actually to use that database infrastructure to track all sorts of other important financial information and activity.
So in theory, that is the way blockchain is intended to benefit financial services. But I think there's still some anticipation, maybe misunderstanding, as you suggest, over what this looks like in practice. And how close are we to actually seeing banks implement this technology and get it off the ground? Because I know that's something you're working with very closely at Digital Asset.
So I think the issue here is that there are some well understood impediments, and I can talk through those. And then I can maybe give some observations as to why I think many of those impediments are actually in the process of being surmounted. With the result, actually, that my view is that we will see this technology in various forms be deployed in a commercial setting in less than a couple of years. That doesn't mean it will become mainstream in that time frame. I think the time frame that it will take to get to be mainstream is more like 5 to 10 years. Mainstream, I mean more commonly used than not for a certain set of applications. But the work that would be needed to be seen to be happening now in order to meet that kind of 5 to 10 year horizon is very clearly ongoing as we speak. So what are the impediments? Typically, there are three factors cited as concern. Number one is the question of uncertainty around regulation. Number two is the question of the challenge of creating a network effect, having multiple parties having to agree on sharing infrastructure. And the last, number three, is the question of the creation of common standards so that you don't have the risk for an early adopter that they inadvertently selected a solution that became the equivalent of Betamax, when in fact the rest of the world goes in the direction of VHS. And actually in this context it's a bit more complicated than that, because it's not just a choice of two, it's a choice of more than two alternatives as we speak. So those are the three things that people regularly get hung up on. And yet when you look at each of them in turn, there are reasons to be optimistic. Number one, on the regulatory front, partly because this invention was originally presented in the context of cryptocurrencies and Bitcoin, initially this drew a lot of skepticism and negativity from regulators who understandably feel that a framework that facilitates anonymous parties to exchange value over the internet has the potential for consumer abuse, violations of KYC, AML, anti-money laundering, sanctions avoidance, and otherwise facilitation of potentially criminal or other untoward activity. So you could understand why the initial reaction to all of that was cautious, and led to an array of admonitions and other constraints put on the adoption of the technology or the use of cryptocurrencies by banks and others. But in reality, as I mentioned in my opening remarks, this is much more a broad set of use cases than simply consumer payments or the invention of alternative currencies. And when you start talking about database infrastructure, which allows parties to mutualize and share information in a more secure environment than the one in which we traditionally operate today, with the result that transaction processing, post-trade in particular, can be sped up, that error rates can be reduced. That leads to a reduction in risk, because assets spend less time tied up in the manufacturing process, if you will, before they're effectively settled. And that offers the opportunity for regulators to have a direct window as an observer into these shared ledgers or this shared infrastructure. Then the conversation with the regulator evolves very quickly to one where they see the potential upside. Now bear in mind that regulators are already armed with a tremendous amount of power when it comes to sensitive market infrastructures. If you want to operate a sensitive market infrastructure, you are by definition a heavily regulated entity, and you have to answer to your regulators obvious questions. Do you have the backup, the capacity, the resiliency, the redundancy, all the other features that you need if you want to be in that line of business? And if you don't, you shall not be in that line of business. It's pretty straightforward. So the power that regulators have to control development of wholesale infrastructure in this space is well established. It doesn't require the reinvention of the law. It means that those like ourselves that are working on the technology need to be able to answer those questions satisfactorily, and in short we can. Do
you think there is a growing awareness, though, among the regulators of the role that blockchain can play in reducing risk?
Absolutely no question. And if you can look to the public domain for that, there are many regulators who have publicly pronounced on the subject, ranging from the Australians, ASIC, the chairman of ASIC made several speeches, the Bank of England has done the same, the ECB is looking at the same, the Federal Reserve working on this. Again, they're not unambiguously endorsing the concept, they are acknowledging that there are potential benefits that, if responsibly pursued, could be of great interest to them.
And you've spent a lot of time in your career, you had a very successful career in Wall Street, looking at risk specifically. Is this the best tool you've seen so far?
It combines an extraordinary number of positive features. So the ability to speed things up and avoid and reduce errors, to eliminate cost by essentially allowing sharing or mutualization of infrastructure, and then ultimately the capacity to reduce capital. And all of this coming in at the time where the operating environment for financial firms is extremely strained, where ROEs are structurally depressed. Anything that can help tackle capital reduction, cost reduction, risk reduction is of, by definition, great interest. The other two areas that are cited as impediments are, as I mentioned, the area of a network effect, sure. How hard it is to persuade multiple entities to get religion and head in the same direction, and the question of standards. And there, I think you're seeing all the signs of the right kind of activity. So the creation of consortiums with many banks and indeed other types of entity involved, where common standards are being discussed, but perhaps more importantly, the creation under the auspices of the Linux Foundation, who brought you many standards in the internet world of something called the Hyperledger Foundation, which is the first instance of multi-party code contribution to an open source project where independent and competing companies, including my own, but other giants like IBM, Intel, some of the forward-thinking companies in this space like Blockstream, have contributed code and are now working together to create a unified or common code base on which people will be able to compete and develop apps, much like they do on the fabric of the internet. So that work is going on. That was announced late in December. And is happening as we speak, and is, I think, really encouraging. There are also already today a number of central infrastructure providers whose job it is to provide shared infrastructure to the rest of the street. The example in the United States is DTCC, which was originally invented in the 60s to deal with an overwhelming backlog of paper certificate processing in the stock market. Today, they provide more predominantly electronic services, but essentially they're central providers of technology. We're working with DTCC, that's in the public domain, to evaluate the use of distributed ledger technology to essentially upgrade aspects of their infrastructure. They are plumbed to every major bank active in the US and many global and international markets. So a decision by them to adopt or embrace this infrastructure creates the opportunity for many others who are banks and customers of the central infrastructure providers to come along for the ride. And it's situations like that that I think offer centralized decision-making and existing centralized provision of infrastructure that will make the adoption process much easier than an arbitrary coming together of independent parties who aren't already relying on some aspect of central infrastructure.
I want to get your thoughts on exchanges as it pertains to that in more detail in just a minute, but going back to what you said about bank profitability still being under stress here, that's one reason why banks should be looking at ways to improve profitability, but yet do they have the willingness to spend right now? Because we're talking about the IT legacy costs at a lot of these banks. That's another concern here. And are you still seeing some skepticism from executives at the big banks in terms of at what point they're actually willing to turn over this technology?
Well, look, I think many people were skeptical, myself included. You know, when I first encountered this space, it was in the context of the noise and the scandals surrounding the subject of Bitcoin. And in all that noise, a lot of people missed this fundamental invention relating to database technology and a secure multi-party interacting environment. But when people realize or are able to distinguish between those two topics and realize that many of the features of the public Bitcoin blockchain are not a necessary feature or are essentially technology specs that can be changed for use in different contexts, then this just becomes a discussion about enterprise technology. Right. And what that in turn becomes is a question of what is it going to cost you in the near term to invest relative to what you can save in the longer term. And typically, your average financial institution will be trying to squeeze, in any given year, 5 or 10% out of its cost base to reinvest in new technologies in order to grow for the future. In an environment where you are consistently and structurally returning ROEs that are below your long-run marginal cost of capital, 5 or 10% per annum is just not going to cut it, right. Especially when revenues themselves are structurally depressed and capital requirements are exponentially rising. In that environment, you're looking to cut tens of percentage points of cost. And the way that this technology facilitates that is to allow institutions to imagine a fundamentally new operational post-trade workflow where many of the zero value-added functions, including essentially reconciliation work, which involves the checking that information kept here is the same as information kept here, is the same as information kept here, some of that internal to institutions and some of that across entities, for the simple reason that nobody thought to keep that information as a single shared prime record or golden source, leading to the need to reconcile these multiple instances. Now, the reason people in the past didn't do that is you couldn't responsibly rely on other providers or other record keepers of your own precious information.
So it's the trust.
The trust factor, yes. So the fact that the security environment here has been fundamentally modified so that no one entity has unilateral edit rights to the databases that we're talking about means you can actually think about genuinely sharing infrastructure. And that leads to the opportunity to cut 30, 40, 50% out of your post-trade processing costs eventually. And by the way, this is not something where you have to spend billions to save billions. We're talking about relatively light layers of software design. It's really data architecture and data reference architecture that is being innovated here. It's not the installation of enormous layers of expensive, capital-intensive infrastructure. It's a change in the way that we record, authenticate, and refer back to sensitive financial information.
But there is the sizable cost of unwinding the existing systems, I would imagine.
Well, again, who are the entities that are responsible for dealing with the stock and flow of the existing trillions of dollars or euros worth of assets in the world? Well, it's these central infrastructure providers, whether in the case of stocks, it's the central securities depository, the clearing entities, the stock exchanges that feed those, the entities responsible for custodial activity, the incumbents that have, and in the case of, for example, DTCC or the CSDs here in Europe, essentially they have the responsibility enshrined under the law for establishing and maintaining clean title to these assets. So yes, if you were to imagine that in order for this world to eventualize itself, to come about, you'd have to wake up one morning and ignore the trillions of dollars of assets in that infrastructure, in the existing world, and just have it all born again in a digital world, that would be awfully ambitious. But that's not what's required here. Go work with the existing incumbent technology providers, allow them to adopt, adapt, and embrace the new technology, allow them to use that technology, and they are able to build you the bridges and the tunnels into the existing stock of assets. That means that you have a viable mechanism for deploying this technology in the real world for the real body of assets that exists today. If you think about the advent of the internet in the early 1990s, we were all challenged to evaluate in advance, what on earth does this mean? And there were lots of stories about clicks versus bricks, and everybody that had a physical implementation of their business was going to get put out of business, and everything was going to happen online. And indeed, what came out of the internet were a few behemoths in the internet world that are companies that didn't exist before, a few examples of deaths, so Blockbuster got taken out of business by streaming services, and the music industry was radically reformed. But the vast majority of everybody else had to adopt and adapt. Every bank on the planet has an online service that it provides to its customers today. This is going to be very similar. You're going to see many firms that are existing providers of financial services take advantage of this infrastructure because it's more secure, it's lower cost, it frees up capital, it allows you to comply with regulatory transparency standards, and in that context, why would you not?
But do we need a first mover to kind of take the plunge and take the lead? Or in a perfect world, when you get back to what you said, a lot of people concerned that there needs to be one standard, some consensus here on the right way to implement the technology. Would you rather see a big group of banks go at once?
So coming back to my comment about central infrastructure providers, they are a single point of decision making, but they serve the whole street. So that counts as essentially one first mover with implications for all their customers. So it's the same thing as a bunch of banks suddenly deciding to move for this. So the good examples that I can talk about that are, because they're in the public domain, include the projects that we're working on for ASX, which is the operator of the Australian post-trade market infrastructure, and DTCC, who I've mentioned before. And in both cases, they're already central infrastructure providers. They're using conventional technology, which is used by their customers, who are essentially the street, the various banks, brokers, and the likes. that infrastructure has to be updated for a variety of practical, technical, and business reasons, and they're evaluating this technology because it's cutting edge to do that. When they roll that out, if they roll that out, they will be rolling that out to multiple customers who, by definition, are already benefiting from the fact that DTCC or ASX are infrastructure providers to the street. And we have, right there, 2 examples of institutions that are conducting giant-scale activity, who have made and are making the investment to evaluate the technology, and who, if they proceed with it, have a ready-made audience of banks and others who already use their infrastructure and will use the replacement infrastructure, provided it can be demonstrated to meet its minimum requirements performance-wise and functionality-wise, which is obviously the work that is happening right now.
And when you talk about the potential for exchanges to implement the technology, right here in Europe, we're looking at quite a large exchange merger pending between LSE and Deutsche Börse. When we talk about consolidation, potential for future mergers among the exchanges, what role would blockchain then potentially play when it comes to helping along more consolidation and reducing risks there?
Well, at an extreme level, one of the commercial motivation for consolidation of these infrastructures is consolidation of expenses, synergies associated with adopting single platforms. If you design blockchain technology correctly, where you won't end up is with one ledger to rule them all, with every asset in the world being transferred using that ledger. What you will end up with is multiple ledgers that are designed for multiple different markets, but correctly designed with the right standards, which is important work going on, for example, within the Hyperledger Foundation, is very focused on what we call interoperability. Interoperability just means consistent, it's a result of consistent technology decisions so that you can, in principle, safely transfer an asset from one ecosystem to the next, one ledger to the next. If you achieve that, and multiple different exchanges, banks or otherwise, users of exchanges, adopt and adapt to interoperable infrastructures, you have the ability essentially to consolidate and to allow assets to transfer across consistent infrastructure, which has the functional equivalent of a technology merger without actually having to have a corporate merger. Right. And as you know, the issues around corporate mergers are often complicated by competition considerations and other national interests, sure, which can get in the way. So on some level, it's a way that falls short of a full-fledged merger of being able to facilitate consistent technology usage across exchange infrastructures, and we're seeing that today. So the ASX project, for example, is being watched closely by Deutsche Börse, who's also an investor in digital asset and working with us on projects, CME, DTCC, to name a few. These are organizations which are watching the development of this technology in order to make the same technology decisions. That doesn't mean necessarily using the same provider. I don't want to suggest an attempt at world domination here, but rather using consistent underlying technology so that different providers can build interoperable systems that will allow them to integrate their businesses where that makes sense.
It's hard to believe we're already out of time. I feel as though we've just simply brushed the surface here, and I'm sure the audience has a lot of questions they still want to get into. But in conclusion, given that this conference is Money 2020, if you were looking ahead, I guess it's only 4 years now, but let's say 5 years at Digital Asset, what do you expect to be doing at that time? Will it still be a matter of getting the exchanges, the banks fully on board, or will you be looking at blockchain uses outside of the financial sector? Where do you think we'll be when it comes to blockchain technology?
Well, we will be vending software solutions all over the world, as we're already beginning to do, to enable our customers, who are large wholesale financial service providers, to do their functions at lower cost and with greater efficiency. All the early work is being done now. The projects have started to have that happen. And in 5 years, we won't yet be at the point where this is completely mainstream technology, not least because to replace any one of these major infrastructures, whether you're replacing it with blockchain technology or anything else, is a multi-year process. But there will be a number of large-scale projects well underway by then. And vis-a-vis the non-financial sector, the financial universe is a large ocean to boil. Our focus is in and around wholesale financial services exclusively. I doubt that will have changed in 5 years, given the scale of that undertaking.
Sure.
But as you know, there are plenty of applications of blockchain technology that go well beyond financial services.
Will it change the world, as some have suggested?
It is doing so as we speak.
All right. Well, thank you very much on that one. Blythe Masters, thank you for speaking to us.